Welcome to Team 7's presentation of accounting for income tax for foreign subsidiaries. We will begin our presentation with the APB 23, exception for earnings that a parent company permanently reinvests in its foreign subsidiaries. We will then proceed to discuss the different tax issues related to Subpart F income for controlled foreign corporations. The last issue we will address is foreign tax credits.
One example of a FAS 109 issue dealing with foreign subsidiaries of a corporation comes with APB 23, or the exception for earnings permanently reinvested. FAS 109 requires U.S. corporations to book any deferred tax assets and liabilities for differences in the book basis and the tax basis of a company's assets. Therefore, when a domestic corporation invests in a foreign subsidiary, and that subsidiary then earns income, for financial accounting purposes, the parent recognizes the income immediately. For income tax purposes, however, the income is not recognized until the income is repatriated, or in other words, paid back to the parent through dividends. This would therefore create a deferred tax liability. But what would happen if a corporation wanted to keep that investment in its subsidiary permanent and never expected to have that income repatriated? APB 23 has created an exception to this FAS 109 requirement for just that. For example, if a domestic corporation wishes to build into a global competitor, it might decide that it wanted to permanently invest in a foreign subsidiary in order to build up in that country, and therefore any repatriation of income back to the parent would be permanently reinvested in that subsidiary. As long as the domestic corporation genuinely never intends to keep any of that repatriation, then under the APB 23 exception, no deferred tax liability must be created at the time of investment, and therefore a favorable permanent difference would result. An APB 23 exception, however, does have financial accounting implications. That is, when a corporation applies APB 23, it must make a footnote disclosure in the financial statements for the cumulative amount of the reinvested earnings, as well as what amount of tax would be due upon repatriation, even though this amount is never booked.
Typically, earnings from a foreign subsidiary are not taxable until the income is repatriated. However, if the subsidiary is a controlled foreign corporation, many income items are excluded from such a deferral and must be recognized immediately by the parent. Income to which these exclusions apply is called Subpart F income. Subpart F income is designed to prevent U.S. citizens, residents, and corporations from artificially deferring otherwise taxable income through the use of foreign entities. Examples of Subpart F income are insurance income, dividend, interest, and royalty income, hedging and foreign currency gains, income from most related party transactions, and all other income multiplied by a predetermined factor. Remember that Subpart F income only applies in the case of a controlled foreign corporation, which is a foreign corporation owned primarily by U.S. citizens, residents, or corporations. Recognition of Subpart F income somewhat simplifies the accounting for income taxes in that it eliminates what would otherwise be a temporary favorable difference, or deferred tax liability. In other words, income that would usually be recognized now but taxed later because of Subpart F is recognized and taxed in the same period.
The foreign tax credit is a means by which double taxation of income that is produced by a foreign sub is reduced and/or eliminated. This situation arises, for example, when a citizen of the United States produces income in a foreign country or when an alien produces income in the United States. The United States in general will not require an individual or business to pay taxes both at home and abroad on the same regular income. The income tax implications of the foreign tax credit are relatively simple. Like most other credits, this tax credit results in a permanent difference between income for financial accounting purposes and for income tax purposes. This permanent difference will in turn lead to a reduced taxable income and a lower effective tax rate. The foreign tax credit is available only on income, war profits, or taxes paid in lieu of such taxes. It is sometimes difficult to determine whether a particular foreign tax falls into the qualifying category. Generally, the following 4 tests must be met for any foreign tax to qualify for the credit. 1. The tax must be imposed on you. 2. You must have paid or accrued the tax. 3. The tax must be the legal and actual foreign tax liability. And 4. The tax must be an income tax or a tax in lieu of an income tax. You can claim the credit for a qualified foreign tax in the year in which you pay or accrue it, depending on your method of accounting. If you are contesting your foreign tax liability, you cannot accrue it and take a credit until the amount of foreign tax due is finally determined. The credit does not apply to tax imposed by countries with which the United States does not have a friendly diplomatic relationship. The computation of the allowable credit. The foreign tax credit is the lesser of 1. The foreign tax paid or accrued, or 2. The portion of U.S. income tax liability attributable to income earned in all foreign countries, also known as the foreign tax credit limitation. This limitation restricts claiming foreign tax credit if the effective foreign tax rate on foreign earnings exceeds the effective U.S. tax rate on these earnings. So if your income is being earned at 45% in another country, you will only be credited up to the 35% rate here in the U.S. for your foreign subsidiary. The foreign tax credit limitation is computed twice, once for passive income and then also, again, for all other income. It is computed by dividing the foreign source taxable income by the worldwide taxable income multiplied by the U.S. income tax before credits. The foreign tax credit may also result in double taxation if the unused credit can't be used as a carryback or a carryover. The foreign tax credit can be carried back 1 year and then is carried forward 10 years to tax years where the limitation is not exceeded, which is the foreign tax credit limitation. Unused credits are lost if they are not used by the end of the 10-year carryback period. Parents of foreign subsidiaries may of course choose to take a deduction for their foreign taxes paid instead of choosing to take the credit. Taken as a deduction, these foreign income taxes will reduce their taxable income from the U.S. However, taken as a credit, the foreign income taxes reduce their U.S. tax liability, and in most cases it is to the parent's advantage to take the foreign income taxes as a foreign tax credit.
Overall, APB 23 turns a temporary difference into a favorable permanent difference. The recognition of Subpart F income eliminates a deferred tax liability by taxing income now rather than when it is repatriated. A foreign tax credit creates a permanent favorable difference by decreasing U.S. taxes up to the lesser of U.S. or foreign tax accrued.